Ram Mohan Rao Amra sir, along with our DMD Finance, Madam Saloni Narayan. I also extend a warm welcome to other DMDs and senior officials of SBI who are present with us this afternoon. We sincerely appreciate your presence at the conference. I now request our Chairman, Setty sir, to address the media and present an overview of SBI financial performance for FY25 as well as Q4 FY25. Over to you, sir.
Good afternoon, ladies and gentlemen. We thank you for your interest in SBI and taking the time out to join the press meet today, post announcement of financial year 2025 results of the bank. Results for the year FY25 highlight continuity, consistency, profitability, and SBI's significant long-term strengths. So I would like to start by thanking all of our stakeholders, including our customers, shareholders, employees, and the broader ecosystem for their support and helping us in creating sustainable value for the economy. Let me first start with a brief description of the present global and domestic economic scenario. Escalation of trade and tariff tensions and the resultant financial market volatility have raised concerns regarding the weakening of global growth in the near term. As per IMF, the estimated global growth is projected to drop to 2.8% in 2025 and 3% in 2026, much below the historical, that is 2000 to 2019, average of 3.7%. As per WTO, world merchandise trade volumes could expand marginally by around 1.7% in 2025. The dampening global economic outlook could impact India's economic growth through weaker external demand, even though the domestic growth engines, consumption and investment are relatively less susceptible to external headwinds. Prospects for the farm sector have been boosted by the forecast of an above-normal southwest monsoon for 2025, which would augment farm incomes and keep food prices under check. Given the exacerbated uncertainties due to recent trade tariffs, RBI has reduced its real GDP growth projection for FY26 by 20 basis points to 6.3% in the April policy. Separately, India's CPI headline inflation has now significantly moderated, and we believe average CPI headline forecast for FY26 could stay below 4% now. During FY25, ASCB's credit growth declined to 11%. It was 20% last year, and deposits to 10.3%. It was last year 13.5%. Term deposits growth continued to outpace growth in savings deposits. Consequently, the share of term deposits in total deposits rose to 62%. CASA declined to below 40%. Asset quality of SCBs improved further, with their GNPA ratio declining to a 14-year low of 2.4% in December 2024. CRAR stood at 16.4% in December, which was much higher than the regulatory minimum ratio. RBI has deployed a strategic mix of interventions, including open market operations, daily variable rate repos, and dollar-rupee swaps. These proactive measures have helped stabilize market liquidity conditions, ensuring financial resilience in an unpredictable global environment. Coming to SBI, the results for the FY25 demonstrate the bank's ability to operate profitably at scale due to our substantial long-term strengths. These advantages stem from our institutionalized framework, which is guided by structured processes and commitment to fairness for all stakeholders. The net profit for the year was 70,901 crores, up 16.08% year-on-year. At the end of FY25, our whole bank credit growth was 12.03% year-on-year, with the domestic credit growth at 11.56%. Deposit growth was 9.48% year-on-year, while the CD ratio was 69.71%. We maintained stellar asset quality with slippage ratio of 0.55%, retail personal slippage ratio at 0.48%, credit cost at 0.38%, and PCR at 74.42%. On the deposit front, at the end of FY25, deposits have crossed 53 trillion, with a customer base of more than 52 crores. Our bank is privileged to serve 1 out of every 3 Indians, and in some way, SBI touches every Indian family. The total deposits have grown by 9.48% year-on-year to 53.82 trillion. Term deposits have grown, as I said, the higher than is savings by 11.48% year-on-year. And our current account deposits have grown by 27% year-on-year, and CASA deposits have grown by 6.34% year-on-year, and the CASA ratio stood at 39.97%. I'm glad to share that the credit growth continues to be good across all segments, though there is some moderation. Our domestic credit has grown by 11.56% year-on-year, driven by 16.86% growth in SME, 14.29% in agriculture, 9% in corporate, and 11.4% in retail personal segments. Our foreign offices advances have grown by 14.84% year-on-year. The domestic credit deposit ratio is 69.71% at the end of FY25, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for FY25 was 0.55%, while the credit costs stood at 0.38%. The net NPA ratio improved by 10 basis points and stands at 0.47%. We have a well-provided NPA book with a PCR at 74.42%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrate the quality of our loan portfolio, the robustness of our underwriting processes, effective collection efficiency, and the leadership of the bank across business lines. Our capital adequacy ratio is at 14.25%, and the CET1 ratio is at 10.81%, are well above the regulatory requirement. Based on the current profitability and growth profile of the bank, we believe we have sufficient headroom to take care of business growth requirements. I'm happy to share the progress we are making in digital banking. More than 8.77 crore customers have registered on YONO, which is pushing forward the digital agenda of the bank. 64% of our regular savings bank accounts are opened through YONO in FY25. Our subsidiaries are consistently performing well and continue to create significant value for all the stakeholders. We will continue to nurture these subsidiaries and maintain leadership position in the respective businesses. We are glad to report that the bank continues to report ROA and ROE greater than 1% and 19% respectively at the end of FY25. While we are glad about the outcomes in FY25, we are also mindful of areas for further improvement and the challenges emerging from various developments taking place across the globe, which may impact Indian economy. On the liabilities side, we continue to focus on increasing our share, our leadership in current account while maintaining the leadership position in savings deposit by further strengthening our customer service and branch network. Although the bank's cost base is substantial, it highlights our commitment to compliance and efficient operations. From this strong position, our goal is to consistently achieve an ROE over 15% through the business cycles. The board has granted approval to raise equity capital up to 25,000 crores, with the authorization being valid for a period of 12 months. This is an enabling resolution. Although we are open to capital raising, such plans will be contingent upon the business needs and market conditions. Wrapping up my initial comments, I express my gratitude for your ongoing support to the bank. As the bank advances its objectives, it also plays a role in driving the progress and economic development of the surrounding ecosystem. We are dedicated to upholding your confidence in us by delivering superior, sustainable returns over the long run. My team and I are now open to taking your questions. Thank you very much.
Thank you so much, sir. We will now move on to media question and answers. To ensure a smooth and orderly session, we will take questions in sequential manner, and individuals will be called by name to ask their questions. We kindly request everyone to please follow the format and limit themselves to 2 questions only, focused on the results. Thank you for the cooperation. We will begin with Mr. Manojit Sahaj from Business Standard, please.
Good afternoon, sir. No, the first thing I want to know is that the profit after tax was down 10%. Can you hear me now?
Yes.
Yeah. So the first thing I would like to ask is that profit after tax for Q4 is down 10% year on year. Is it mainly because of the margin pressure because of the RBI rate cut, or there are other factors also?
See, from year on year, right?
Yeah.
The quarter Q4 and Q4 of
Yes.
FY25. There were some one-offs on the Q4 FY24, particularly on the provisioning write-backs and all. So obviously those write-backs were not there available in this. That is the main reason. Otherwise, the NII and all are performing well. There's no major reason for rate cut will play out going forward. I think there is some impact on the of the rate cut because 25 basis point rate cut was also there in the last quarter, and while we contained the cost of deposits and resources, there has been some impact of margins, but that will get reflected going forward. If you see, yield and advances and other things are stable.
Yeah, but NII growth is almost flat, and the margin pressure. So going ahead, how long do you expect this margin pressure to continue?
See, the outlook is completely dependent on the rate cycle. And with the benign inflation scenario, what we have, we expect that there would be further rate cuts. And while the end rate cut by FY26 depends, how the policy rate cut will progress, we expect another 50 basis point rate cuts, and starting with 25 basis point in the next MPC, which means there definitely going to be some pressure on the margins. We are not able to put any number on the margin pressure, but pressure definitely is going to be there because some of the portfolio gets repriced immediately with the policy rate cut, while the deposits will take some time. And the lag is generally 12 to 18 months for the existing stock to get repriced, while the incremental deposits will get immediately repriced as we cut the rates on the deposits. So this lag impact will be having some margin pressure, while we do not have any guidance on what could be the pressure in the quantifiable terms.
Also, if you can throw some light on the future roadmap on loan growth, because RBI, if you see, have infused lots of liquidity. The main reason was transmission, but also to push credit growth, which has fallen very sharply. It was 10%. Yesterday the data came out. So do you think credit pickup will be there in FY26, and what is SBI's guidance for credit growth?
So our earlier guidance was 14 to 16%, if you remember, and we are moderating that to 12 to 13%. But system level credit growth probably would be 10 to 11%. The only upside which would be possible is that how quickly the tariff-related clarifications will come. Though Indian economy is broadly insulated, I don't say insulated, but less impacted by the tariffs overall. As I mentioned in my initial remarks also, our consumption-driven economy, I think, would be holding up well. Our exports to the US also are limited. But I think the uncertainty on tariffs is going to impact the overall economic scenario and investment scenario. So from that background, we believe that there will be some moderation in the credit growth rates.
Thank you. Thank you, sir.